Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about the biggest risk of releasing the GSEs from conservatorship, plus mortgage rates and home sales. First, I want to thank our sponsor, Rocket Close, for making this episode possible. Logan, welcome back to the podcast.
It is wonderful to be here. As you can see, I just got out of the shower, so the hair is pretty crazy.
We have a lot to cover today. You had 3 different articles over the weekend because so much was going on. Where do you want to start?
Well, I think the main thing is the GSC's plan of removing Freddie and Fannie in risk now, right?
Yep.
And what I've tried to do is, we always say be the detective, not the troll. So try to figure out what people are wanting to do by their wording, body language, or stuff like that. So obviously the White House's whole thing was getting the 10-year yield lower. Okay, so hear me out for a second with this theory I have. The 10-year yield going lower and mortgage rates going lower, housing demand picks up. That's something President Trump could say, hey, look at it, where people are buying homes again, you couldn't do that under Biden because we have record low levels of sales, like his lowest levels of sales ever. So when the 10-year yield actually went lower and demand picks up a little bit, you could run it. But because of the trade war and all this stuff that's happening, bond yields had gone up again. By the way, the 10-year yield is at 4.45% today. So I just want to know what happened to the budget, the deficit. What happened to all that? All those crazy headlines. Oh my God, the bond market is scared of the deficit. The bond market, you better watch out, man. We might get back to the 1990s, 7%.
Did not happen.
Come on now. People, come on now. Y'all need to relax. This is why we say Gen Xers, we should be able to handle this stuff. The baby boomers, well, whatever. But in any case, now that bond yields are up, what happened Monday night, the head of the FHFA, Bill Pulte, went on social media and said, enough's enough. The Federal Reserve needs to cut rates. And a lot of people go, well, that's not how the bond market, no, where 65 to 75% of where the 10-year yield can range is where Fed policy is. Just go back. I always like to use 1971 to now because we had that, unique uptick in rates going to 18% and coming back down. But what if it's something else? What if the whole plan of removing the GSEs, because Bessent came out and talked about this, and and we wrote that article as well, that he said, listen, if this is going to, make mortgage spreads wide, then we're not going to do this. But I think it's a lot harder for them to do something like that now because bond yields are up and mortgage rates are up. And then if mortgage rates go up to 8% again because of something they did, it's not like this trade war has been going on perfectly. Myron, I'm supposedly, if I believe the stories, J.D. Vance is mad because Myron told everybody the dollar would go up. Don't worry about any companies eating it. You don't need to. And that hasn't happened. I still don't believe that story. I think authentically, they're just throwing Myron underneath the bus. I think that's the whole low dollar thing is that. But it becomes a little bit more difficult to kind of weigh the risk of getting Freddie and Fannie out in this environment. Hypothetical, let's just say mortgage rates are at 5.5%. Home sales pick up a little bit, then you got a little bit of a better backdrop. My contention has always been that don't worry, and I hope the Treasury and anybody's listening, anybody who works for the Treasury and all that stuff, it's not the concern of now, because they always say there's a 0.25% move, maybe higher rates or 0.5%. It's when things get bad and the market deteriorates and you have market drama, the spreads in theory can get much wider than what we've been historically normal to, right? Because we always think like 3% is very high. Without the quote unquote government backing in there, why couldn't the spreads go to 4, 5, 6, 7%? Because it's always the time when there's risk. Like we always talk like, look at these bank stocks. Oh, these banks have been here for a long time. Well, Silicon Valley gone, right? Some of the other banks gone. Some people say that they should have let Silicon Valley banking and everything go under because then these tech bros would understand, they would get a whooping instead of going on their podcasts and yapping off about nothing. But I think it's just become a little bit more difficult to start the process of the GSCs if you know there is some inherent risk, and then trying to explain that to the public.
So I think something that you wrote about in that article that really struck me was like one of the risks that people maybe aren't thinking about if you take the GSEs out of conservatorship is just the state level risk, or the more specific risk when it comes to climate change. If you don't have the federal government doing that kind of backstop, it's like you have to actually price in way more risk for Florida, for Texas, for states that are hit by these natural disasters than what people currently have to worry about when it comes to the mortgages.
So the greenies would tell you that Freddie and Fannie are allowing, climate risk to go on because they're not pricing Florida or these places more aggressively. So, and that's like a very coherent thought process. I'm surprised they even came up with that. But in this case, they're right. If you have no government backing, why shouldn't in Florida be targeted much higher, especially if there's inherent risk to the loans and all of a sudden hurricanes and oh God, and if FEMA's not going to come in and bail some things out, they're on the hook,
Yep.
right? So that's a conversation that, because when I went on Yahoo Finance early 2024, and I said that there are some parts of the country that just some people just will refuse to live in. But what if banks don't even want to bank there? I know Jerome Powell's talked about that, 10 to 15 years, maybe some areas aren't bankable. You take the GSCs off of government support. Why wouldn't Florida or Texas or Oklahoma, places where you have climate risk, California, why wouldn't mortgage pricing be higher in that area if you want to offset risk? Because that's what a lot of environmental people have always said, that Freddie and Fannie are facilitating, or mitigating the climate change risk in these areas because they're allowing pricing to be normal. So that's another thing to think about as well going out in the future. So you got that, you got rates still elevated, you got possibly mortgage spreads getting wider. But now Bessent said, well, I'm going to look at this, and if it does seem like it's going to go that way, we won't do it. But I think if mortgage rates had gone lower and stayed there for a while, they have an easier backdrop. This is why I was very curious when Trump put that social media post out about, I'm seriously considering this. So you could understand some people's apprehension on all this, because the trade war just seems like we're just throwing stuff in the air, whatever. Hassett comes out today and says, hey, listen, we're going to get all the tariffs down to 10% or maybe lower. It just seems like this can't be one of these, okay, we're just throwing tariff numbers out or whatever, and threatening people on one night and then taking it away. When you do this, you're all in. You are all in, because unless you're taking them back into conservatorship or whatever, this is not something you could just say one weekend and then Monday morning change it. So I think there might be some apprehension now. Maybe Bessent has already talked to some investors and they go, oh, homie, we are not giving you that kind of pricing ever again once they're out. So I think that's something to think about going out in the future. If this doesn't happen this year, or if it comes to fruition that, we just want to deal with the trade war and everything, and then we'll deal with this later on. And then, they could get a shadow Fed president, and then they could lower rates, and then you could fight this battle another time in a better environment than what you're doing right now. And I think maybe a part of that is Bill Pulte coming out and go, enough is enough. You need the Fed to cut rates.
So we'll get to that Pulte announcement in just a second, but I did want to kind of dig in here from your perspective. What is the financial gain that we get on both sides, right? Like, we know what Fannie and Freddie do right now for the Treasury. What does it look like? Like, what is, from a fiscal standpoint? No, from a money standpoint. I just want to make sure I use that correctly. Like, for the United States, what makes the United States more money?
Well, I think hedge funds just want more money. I think this is a hedge fund thing. Nobody's talking about GSE reform except for like Bill Ackman and Fleckenstein and all these people, right?
So this is my question: what's the benefit to everybody else?
No, there's like these crazy Freddie. I don't know. You remember those crazy Freddie Fannie people on Twitter?
Oh yeah,
like
no, Fannie.
Oh Lord, oh my goodness, that was a fun. Those guys were fun. They were just completely, I mean, they were hired people, bots,
I
whatever.
shouldn't have even said the name. It will bring
Oh
the wrath
Lord,
down
you want to
upon us.
talk about men that need a job? Get these people hired somewhere else, because they literally spent 24/7 talking about Freddie and Fannie. So let's talk about, what is the biggest financial asset the United States government has? Student loan debt.
Oh.
Student loan debt, we have like $1.6 trillion. What? Hey, listen, we're collecting student loan debt payments. By the way, there's a lot of, like, over 2.4 million FICO scores just got hammered by it. Again, you see this, the process isn't fluid, right? Some things not work. When you do things so fast right away, mistakes happen. So now that we're collecting payments now, or interest, guess who gets the money? The United States government. Right? The government became the biggest player. And guess who gets that? The Treasury, whatever, deficits, we take that money and we pay down, or we're never paying down, but we put that into the budget plan. What if the other intention for the GSCs is to create a kind of wealth sovereigns fund? And listen, all of you around the world, you can buy, Freddie and Fannie, whatever the combined entity or whatever it is, and raise a ton of money around the world, and you could buy a piece of America out there. You're probably going to have to give them a really big valuation for that to even make sense. The amount of money these two giants need to have capital for protect is massive. So maybe they want that. So they go, okay, we're collecting money on student loan debt interest to put into the budget, and then we're going to collect this, and then we could put this in the budget. Maybe that's the game plan. But I just go, everything was working fine with them in conservatorship. Right. There, we had no problem. Everything flowed. You could say that the politics of whoever is in charge of the FHFA, things can change, of course. X could happen with Republicans, X could happen with Democrats, and that is a certain amount of a job. But the system worked. I mean, the world hates us because we have Freddie and Fannie. That's what it is. Other countries don't have the plumbing that we do. So in this case, they're fine. There's nothing that we get. But if you want to, like, collect money like you do with student loan debt and say, let's just make this a really big valuation, get investors around the world to take that money and put it into the budget, maybe that's the end game plan here. But I've always said they're perfectly functioning entities in conservatorship. We never have to worry about, they make so much money that they give to the treasuries, right? They're doing great. They're one of our best performing things for the government in that sense. It's a complete success. But I think just some hedge funds, people want their preferred shares or, stocks, and that's kind of how it operates. So you can understand there are some people going, whoa, do we, after everything that's been happening right now, is this the time we really want to do this? Right? Or maybe we want to wait maybe 2 years or something. Because I could see Trump going, okay, I want Warsh. Warsh is going to cut the Fed funds rate by 1.5%. Mortgage rates will be at 5.5%. Then we could maybe do something like this. Okay, I get that. But now I got a sense that the sense is like, we're going to take a look at this, because the 10-year yield has gone up and mortgage rates have gone up. And there's a lot of people asking questions. Is this the time to do something like that?
Well, we've talked a lot about the fact that, like, the higher mortgage rates, like them doing something that makes mortgage rates go up. Nope. Nobody's going to think that's a win. That's not going to be good for anybody. That's the last thing that they want.
Bill Ackman will love it or something, hedge funds, Wall Street will love it. They'll get their stuff. But again, these are two really significant, important pieces to the U.S. economy. I mean, why do you think we have the longest economic and job expansion? Like, literally, if you took COVID out of the equation, we would have still had that expansion. We have a funding system with the majority of consumption debt tied to housing, and it was fluid, right? If you get into a situation where you're a publicly traded company, we saw what happened to the banks, right? You see all those tech podcast people. Could you imagine when they were begging, Janet Yellen, please go help us over the weekend. You got to save these banks. You can't destroy, so some people go, we should have let him happen. Then these guys can't yap off on their podcast right now. But with Freddie and Fannie, they had to take him in conservatorship. I mean, their leverage ratio is like 72 to 75 to 1, so it's a working thing. So wherever we go, we got some good clues into what's going on in the process. And obviously, the White House and everybody on the economic team wants the 10-year yield lower, wants mortgage rates lower. So this is the whole shadow Fed president, Trump going after Bessent. Everyone wants to, there's a reason for that. And we highlighted some of the, in the article that we wrote with Bill Pulte talking about it, we highlighted some of the risks if rates stay elevated, tied to the economic cycle or tied to the GSC reform plan, stuff like that, have gone with other economic cycles as well.
So let's talk a little bit about Pulte's announcement on Twitter, where he said, like you said, enough is enough. Powell needs to lower interest rates. And so the interesting thing about that is we know that, first of all, it was settled last week by the Supreme Court that Trump can not fire Powell. He can fire the heads of other independent agencies, but they did a carve out just for Powell, just for the Federal Reserve. So, does it mean anything if Pulte or whoever it is saying, Jay Powell, you got to lower interest rates? Because he's already shown that like he's not going to really bend under that pressure.
This is where the shadow Fed president comes in. So on October of 2024, before Trump won, Bessent talked about, if we get somebody that we tell the market, this is our guy, or you just basically say Powell's finished, this is his last thing. So bond traders, you're here to make money. So our guy is telling you, start trading the 10-year yield, with a Fed funds rate 1 to 1.5% lower. I always thought that is a more plausible theory than firing Powell. So we have other Fed presidents who are talking about, yeah, listen, we want to focus on labor, right? We have rate cuts coming in if the labor market breaks, stuff like that. But in this case, if you want to look out, it would be a more coherent plan to do the shadow Fed president in this environment if Jerome Powell. And you think about it in this way, millions of people buy homes. I mean, outside of like the doomer crowd, lower mortgage rates, people buy homes, people have sex, they have kids, they have all this stuff, and Trump could take victory for it. So now you're working a crowd and having all your soldiers basically say, hey, what's up? Hey, you know what? He's not going to do us any good. We're going to put X here. X going to be the next Fed chairman. Go ahead. He's going to go on TV and go, we're lowering rates, so get ready. Bond traders, get ready. That's what a shadow Fed president, in theory, can do. We'll cross that bridge if we get there. But again, it's something to think about. Again, for me, it's always been labor over inflation. If the labor market breaks, then you could get your lower mortgage rates for longer. But we're just kind of hovering here. I mean, thankfully, the mortgage spreads are improved, or else, again, this whole year would be at 8% mortgage rates. And again, that's one of the reasons why I think it's a little bit difficult for Bessent to go into the GSEs, because if we had 8-9% mortgage rates because the spreads got bad because the GSEs aren't backed up, it's a tough sell. It's a tough sell when you got billionaire Wall Street people talking about, we have to, get him into conservatorship. I need my preferred shares and stuff like that. And then you have the entire country out there. So I think the White House understands that backdrop and how that looks. If you don't do your due diligence and ask bond investors, hey, if we do this, where are the spreads going? They're going to go, it's going to go up here. Hey, if we do this, how are we pricing Florida? It's going to go up here,
Right.
So.
Well, and interesting to think about, if you're thinking about midterms, if you're thinking about the next election cycle, Florida's really key to a lot of things. Like you have to be careful politically what you do with Florida too, right?
Yeah, I mean, I'll tell you this: it's a very easy win-win. If mortgage rates go lower for Trump, and he's just going to say, "Look, we got." I mean, that was the whole marketing plan, right? The 10-year yield went down originally. You had some demand pickup. It's really weird when you think about this. We'll talk about this a little bit later, but new home sales, purchase application data for new homes just surpassed the pre-COVID high. Nobody knows this. Nobody even looks at it. It's so weird that this data line is really critical. Nobody really looks at it. But imagine if rates had gone lower and all of a sudden home sales are really picking up. And then places like Florida and Texas benefit, or red states, you get people riled up. And then other states where you have that are in kind of middle of the grounds, they go, hey, listen, rates are lower now. So it's a political economic play, because millions of people buy homes every single year, and that was one of the negative aspects the last few years, that rates were just elevated.
Let's go into the housing market tracker for last week, which I thought it was really interesting. So you have now incorporated a new data line. Tell us about that.
I know I've got a word count, man. It's like, if it was up to me, I'd have like 50 charts and
Oh, I know.
4,000.
I know you
And then it's
would.
like, nobody's ever going to read this. The Google SEOs are going to, so I've had to condense some things, but we added another chart. We have our total pending charts, which is kind of like a moving average of where sales are. And that's our data recently gotten better on the year over year, but just remember, comps are starting to get easy. So we incorporated the weekly charts as well. This is just the week to week data to show it's a very volatile, and you could, holiday week or one thing could really mess things up. But that gives you a more fresher look about the current week to go with the total pendings. And one of the things I've highlighted in that is like, man, we're going to have like a lot of easy comps. So if we have year over year growth in the existing home sales from June to October, right, we have one more month where we're going to have sales above 4 million to work off of. Then just put it in a little bit more context. And this is trying to explain housing data. I mean, think about it. Just like take a step back. New home sales purchase application data is at pre-COVID highs, like above 2020. We're still like 200,000 home sales away from getting to that peak. Purchase application data is up 16 weeks in a row. Well, by the time this podcast comes out, we'll know if it's 17. If you look at that, you think it's fine, but these things need to be explained. So the tracker, again, for me, is pro supply. Higher mortgage rates can create higher inventory. We're almost back to normal in what I would consider perfectly acceptable. My low inventory theory goes, or discussion goes all the way. And it's based on that the one positive about higher rates, it can allow inventory to grow. Mike Simonson and myself, when we did our first podcast together, where we talked about this, and one of the things I told him said, I believe that if rates stay high enough and demand is suppressed, you can get inventory to 2019 levels. Now, it's like 10 states right now, but as a country, we're not that far off from getting to the lower end of 2019 inventory data for the NAR spot. Now, it's the seasonal peak, and then that's going to decline. You want to start the year at 1.52 million and work off of that. We obviously didn't start that from that position. We can maybe get the underneath, but at least we're here, and that's positive, because that means you can't have prices escalate. The affordability works itself through that. Wages grow, households grow, dual incomes, price growth slows down. Case-Shiller came out again today, year over year growth 3.4%. But for my forecast to be right, this thing has to get noticeably softer the rest of the year. And we're like 3-4 months ahead of Case-Shiller. So we kind of see it. And that's why the tracker, to me, again, 2025 and 2024 positive. 2020, 2021, early 2022, savagely unhealthy. Worst housing market I've seen since, that wasn't good. Here, you're setting yourself up for better demand in the future. Back then, you're setting yourself up for an absolute collapse in home sales, and that's what we got. And this is why I look at housing a little bit different than everybody. I just want to teach people how to look at data so they can understand it better. And then when they understand it better, they can talk to their clients, and then their clients get to see it and understand it better. And that's really boring, non-sexy work, but it's the right way to do economics.
So I do think it's interesting. We're at the end of May here. So we are really through the spring home buying, what you would call the peak home buying months, right? And so now we'll see what happens this summer, which also is very rate driven. Like if we get lower rates for different reasons, that could definitely spike up again, right?
Last year I lost my price forecast. I was too low because mortgage rates started to fall last year at this time. And when they fell near 6%. It's always near 6% that the data gets. And then all of a sudden, the forward-looking data started to get better. But because people just were looking at old stale data, they didn't see it. And all of a sudden, we had a couple 100,000 higher in home sales. Everyone's like, where the hell did this come from? Because people are looking at the mortgage purchase application data and they see the low volumes. They don't think you could
Right.
gain a couple 100,000 in home sales. And that's kind of happened toward the end of the year last year. So here we have growth. Now, I would say one thing, we're seeing less cash buyers as a percentage of sales, and sales are roughly kind of the same. So in that case, we have less cash buyers, but mortgage demand has performed much better. And it's really, I mean, we're still at elevated rates and it's holding up. So I'll be surprised, but maybe we do have 17 straight weeks of positive year-over-year data. And again, the comps are going to be really low. I'm talking like the historical mother of all low comps, but we'll see. Again, I've always looked at it as housing demand gets better when rates get towards 6%. It is the duration of the curve that matters. This is why Trump, Bessent, Pulte, they all want lower rates, so you can get lower rates for a little bit longer. Not 3, not 4, not 5, but just getting towards 6. You can get something going on that front. And we have so much more inventory than we did in 2022 that it'll be okay. You don't have to worry about home prices going up 10, 15, 20%. Or these people go, oh my God, your prices are going to escalate. No, there's enough inventory. Rates are not that low. We're in a much better spot now.
It's so interesting because we have the people who are like, oh, prices are going to escalate because there's not enough inventory. And then the people are like, there's too much inventory. It's crashing. This is showing, all this stress in the
Millennials
system.
and baby boomers. That's what it is. That's what it is. These are bad. Let these two fight with each other, man. Gen Xers, we got this. We all good.
We do have this.
We play ball. We play ball. We just handle things differently. But
yeah, Gen X. Hey, we're the best generation for a reason.
No, I mean, honestly, I always tell people, you remember those or like when you go to the park, we had those spinning things.
The merry-go-round?
Yeah, we spin, like you'd have to hold on to this thing. If you didn't hold on to it, you'd die. Like our play times, like we had no safe spaces. You go out there, you could get yourself killed in one of these parks, man. The little seesaw, and you get hit and you fall off, and we'd have to dial our phones. Like we didn't have like Chat GBT or anything, and if we mess something up, we have to start over again, and then we have to like call in to find out what movie theaters, like what time it is, and we have to stay on there the whole time. And I mean, we just did things differently.
You had to call in for the weather.
Yeah.
Do you remember, like, for the weather and the time, you would dial a phone number and find out what the exact time was?
Yeah, so we grew up in that environment, so naturally we could take care of business, right? We're not this, but the baby boomers, millennials, oh, it's crying, it's this and that and this. We need more Social Security. We need this, so. It is what it is.
Logan, you and I, we're gonna make Gen X great again. We're gonna.
Well, we don't need to do it. Gen X was always great. We were always playing ball. It's these baby boomers and millennials that are always like, these two, let them fight and cry it out. But we're good. We were always the best out here.
Okay, well, thank you so much for being on today. So much going on. Appreciate all your work on this, and we will talk to you again soon.
Okay.